market. David Pezarkar, Chief Investment Officer Equities with Bank of India AXA Investment Managers, joins us live with his fundamental take. David, good morning. Thank you for joining us. David, we are sitting at an all-time high, and stock markets are often considered as a barometer of Indian economy. So even though markets are at an all-time high, fundamentally and economically nothing is going our way.
Stock markets actually move on incremental delta changes that they see in the economy. They are not backward-looking markets in that sense. We all know the macroeconomic situation, but what stock markets try to see is whether there is any incremental positive change that is likely to happen, whether all the bad news has been discounted, and whether the valuations are at a certain level where all that negativity has already been factored in. So what we are seeing is that if you look at the recent quarterly numbers, people were not expecting much, but we have seen sector after sector, we have seen incremental companies, except for perhaps the cement and the real estate sector. We have seen most of the sectors where companies have, if not massively surprised, but they have at least met expectations, and in some cases they have definitely surprised on the upside. In certain cases we have seen volumes which are slightly better, for example in the auto sector. In some cases we have seen better margin performance. So I think what has happened is that the market has seen the possibility of an earnings upgrade down the line, and possibly some sort of political realignment which will result in industry sentiment improving, and that is what the market seems to be factoring in now. That is why I think the sentiment has turned so positively, and while we have seen such a sharp rally from the lows of August, and which might result in some sort of a mild correction, but I think the underlying sentiment is likely to remain positive in the near term.
David, hi, morning. What did you make of the PSU banking pack and the kind of rally some of these names saw yesterday, reacting to better than expected asset quality?
Well, I think it was more of a reaction to the fact that they were beaten down to extremely low valuation multiples, and basically the issue that one has with public sector banks is that while their book value appears optically cheap, but if you look at their sustainable ROE, and if you look at the amount of restructuring that they have done, and if you adjust their book to that number, and then also you have the fear of a dilution below book value because their tier 1 ratios are extremely constrained. So that is why we have had investors stay away from that sector, and that had resulted in a complete shift away from that sector. So people are not exposed to that sector at all, and that is a overreaction because some of the numbers turned out to be not so bad as expected. But if we want to see a sustenance of this kind of a move, then I think we will need a couple of quarters more of reduced impairments. Otherwise, I think this is just more of a trading bounce.
Let's talk about the consumption end of the market. Are you getting a sense that the springtime for FMCG and consumer staples is over? A, valuations are looking rich. B, there is a serious concern when it comes to volume growth, and top consumer companies are now struggling with volume growth because of high inflation.
Well, I think we have seen mixed numbers there. Some companies have seen decent volume growth, and the rural part of the economy continues to be positive. And companies, of course, have had to increase their advertising spend to sustain that volume growth. But I think if you look at the long-term story, then the underlying demand for consumer staples is likely to remain strong. But on the other hand, market also looks at the relative valuations of that sector. And that is what has happened. So I think there is some sort of a shift away from the expensive sectors to the other parts of the economy which are more reliant on a cyclical kind of a bounce back, and that is a natural kind of a progression, because the market has to rotate, and the rally has to have further legs for its upward momentum. So I think that is a natural reaction, but we do not expect consumer companies to perform to underperform, at least in terms of their earnings. The valuations are, of course, a different matter.
David, what about pharma as a space? We saw earnings from Dr. Reddy's yesterday. They beat street estimates, but do you think the stock saw some profit taking because it's run up so much?
Absolutely. The pharma rally is largely based on the rupee depreciation, and what we have seen is that we have seen a period of stabilization for the rupee. So incrementally, there is not so much of a risk of the rupee depreciating from here, which is why there is a reduced probability of healthcare profits being more than what people are estimating, and the market is likely to move up or down based on whether the actual is likely to be different from the expectation. And in this case, it doesn't appear that the actuals are going to be extremely above the expectations which are already built in. So, which is why we have seen some sort of a profit taking here, and a shift to the other sectors where the actual might be slightly better than the pessimistic sort of expectations there.
David, in your current portfolio strategy, how are you allocating capital? What is your total exposure to the BFSI space, and within that, how much are you exposed to private banks?
Well, we are slightly overweight the overall BFSI space, but like most of the other portfolio allocators, we have stayed away from the public sector pack, and we would like to see sustained couple of quarters of improvement in terms of asset quality, lesser restructuring, and we would also like to see how the banks are able to sustainably increase their business without continuously resorting to loads of capital from the government. So there are too many concerns. While the valuations for the public sector banks remain low, but as of now, we would prefer to play any cyclical upswing in the economy through the private sector bank route.
David, do you like any of the auto names? Maruti performed pretty well in its earnings this time. You've also got Tata Motors, wherein JLR continues to contribute to the performance.
Yes, we are positive on the auto space. We are also positive on the consumer discretionary space overall, and we expect that in the second half of the year we will see a overall bounce back in the consumer sentiment, and we prefer four-wheelers there, but we expect the two-wheeler companies also to report positive numbers. So we are overall positively tuned to the auto and consumer discretionary space, and we also like media companies there. So we are hopeful of a rebound in the second half of the year in that space.
So David, if you are bullish on banks, you have a decent exposure to IT, you like media, you own autos, what exactly are you bearish on?
Well, we are underweight the capital goods, industrials and utilities sectors, and we think that there are still some balance sheet constraints there, and which are likely to persist. So in those spaces, we would like to see better execution happening before we tilt our portfolios there. So those are the spaces where we are underweight as of now. We are also positive on healthcare, and we are also overweight on telecom space in our portfolios.
David, what do you like from the mid-cap consumption space as a theme, as an idea, as a business?
Well, there are a number of Indian companies who have built extremely strong brands, and we are positively inclined towards a number of those mid-cap consumption companies, because we think that if you look at the relative valuations in that space, and if you look at the larger companies, then you have the smaller sized Indian companies which are trading at more attractive numbers, given the kind of growth that they could achieve as they increase their penetration. So we are positive on Indian consumer names, some of the companies which have acquired brands globally and have successfully, incrementally contributed to their growth. So overall, I think it would be a prudent strategy to have a select exposure to the mid-cap consumption space.